Essentially, kerosene was thrown into a fire that was already burning, and the bank was overrun with depositors trying to get their money out.
It is a blessing. Yeah. Lift up my eyes to the hills, I'm blessed, oh man.
Hey guys, my name is Chris Jamar and welcome back to my YouTube channel. So I know it's been quite some while since my last video, but I really wanted to take some time out to solidify my messaging and fine tune how I want to add value to my content. So if you are already subscribed, this is probably what you were used to. So essentially what I want to do here is help you create better money habits and just secure your best financial future. What that will look like is I intend to share information related to earning, saving, or investing. But now, here's how things will go on. On this channel, I want to inform you and empower you about financial wellness. I also want to break down the news stories you need about the economy, your money, and your career. So with me now talking about news stories, I plan to give an update about the latest Supreme Court hearing on student loan forgiveness. But with the Silicon Valley Bank collapse happening just this past weekend, I feel like it could be a more fitting first video bet. And there's some lessons here even if you may not feel affected. So if you aren't already aware, Silicon Valley Bank collapsed Friday morning after a crazy 48 hours in which a bank run and a capital crisis led to the second largest failure of a financial institution in US history. And we're all wondering what happened. So it's a little complicated, but also somewhat simple. But first, what is a bank run? A bank run occurs when depositors try to pull out all their money at once. Sometimes the actual cash isn't immediately there because the bank uses it for other things. That was the immediate cost of the capital crisis, but to get to that point, a lot of other things also had to happen first. How did we get here? Silicon Valley Bank was the bank to the venture capital world and tech sectors. For example, Roku had close to $500 million with the bank. A bit of background, during and after the pandemic, VC and tech companies raised an extraordinary amount of money to invest in and to run young companies. Much of that money ended up at the Silicon Valley Bank. The bank ended the first quarter of 2020 with just over $60 billion in total deposits. That skyrocketed to just $200 billion by the end of the first quarter of 2022. What did the bank do? So they have all that money and are basically like, what do we do with it? Ironically, in an effort to be conservative, the bank took the deposits it received and bought traditionally secure US Treasuries and government mortgage-backed securities. These mortgage-backed securities are/were, for all intent and purposes, as safe as houses. Why is that a problem? These securities are at virtually no risk of defaulting, while they pay fixed interest rates for many years. This isn't necessarily a problem unless the bank suddenly needs to sell those securities. Now let's talk interest rates. Bonds have an inverse relationship with interest rates. When rates rise, bond prices fall. So when the Federal Reserve started to hike rates rapidly to combat the inflation we're seeing in the economy, the bank's bond portfolio started to lose significant value, and as a result, they could only be sold at a loss. What else happened, you may ask? When interest rates rose, VCs stopped flinging money all around. Startups started drawing down more of their money to pay for their expenses. They stopped getting new funds from public offerings and fundraisings, and the bank deposit inflows turned into outflows. In order to meet the potential outflows and have some flexibility on their balance sheet, Silicon Valley Bank sold $21 billion of securities, resulting in an after-tax loss of about $1.8 billion. It also set out to raise about $2.25 billion in capital. The outcome? The bank attempted to do a large stock sale to shore up their balance sheet, but by then the classic panic was already underway. The stock got crushed. Things unraveled quickly once many famous VC investors told their VC-backed companies to pull their money out of the bank. Essentially, kerosene was thrown into a fire that was already burning, and the bank was overrun with depositors trying to get their money out. According to a filing by California regulators, customers tried to withdraw $42 billion worth of deposits, about a quarter of the bank's total. The collapse was inevitable and they ran out of cash. By Friday, California regulators closed on the tech lender and it put the control of the bank under the FDIC, or the Federal Deposit Insurance Corporation. The FDIC, or the Federal Deposit Insurance Corporation, insures depositors in American banks up to $250,000. Any depositor with a balance of the FDIC insured amount of $250,000 or less were assured they would get their money back by today, Monday. Unfortunately, that's just a small amount of the bank's customers. The vast majority of depositors had far bigger deposits, and the fate of that money and of some of those companies are now a little bit uncertain. They should be able to get some of their money back, but it's a little bit unclear when and how much they'll be able to recover. Now, there's a lot more I could get into, and I'm sure there are more updates as of today, and we'll see more throughout this week, but that's it for now. Maybe I'll do a part 2. Comment if you want a part 2. If this helped you to understand what happened with Silicon Valley Bank, please like this video, comment, and do me a favor and share with a friend if it may help. Don't forget to subscribe. See you next time.